Hey everyone, I hope that you're doing well, and I hope that you're ready for the second video that I'm doing now with Fitbits. My computer's asking me for updates, so that's going to go away. I hope you guys are doing well. I'm sure it's pretty hard to be studying at home when you don't have the pressure of having to come to lectures or anything like that, but I think this tut's going to be really useful. So please I hope before you watch this video you've actually done it properly. This is a test from about 3 years ago. I think it's the first question I ever set when I came to UW, and let's just say people didn't do too well when they wrote it. So yeah, I hope that it's going to be a useful tut. Let's get right into it. Now, you can see straight away 73 marks. I actually think when I made it was more. I've taken a few off. And again, you're lucky you see the words ignore that. And what we're dealing with here is a gym. Is called Fitbit, and basically some of their staff are away on events, whatever it might be, so they've asked for your help, the generic type of start. The key things that you need to note: the year end is Feb, which matches the year end of an individual as well. Okay, and what you're going to notice through this question is that you're going to be dealing with Fitbit and some other parties. So you're not going to be doing just the tax of Fitbit, you're going to be doing the tax of some other people as well. Now, starting off with Fitbits, we need to just look and see what happened. And basically, during the year there was a fire. They give you the information about the original building that was destroyed. And because of the fire, they got insurance payouts of 4.5 million. They used these insurance payouts to buy a new spot within Belleville Mall, and that had previously been used as a restaurant. So the key things you need to remember here is you've got old building, you've got new building, and old building is going to have allowances, and because it was destroyed, that's a disposal event, so you're going to have possible proceeds, or you're going to have possible recoupments and CGT. Then new building, you have to look and think, well, are there going to be any allowances? And on both you have to think, is there going to be a rollover of the CGT and the recoupments? Also, in the fire, we did not insure our gym equipment, and this is what we had bought. So just remember, the fire happened in April, and this is the new equipment that we bought in June. We bought 100 new treadmills, and the key thing here, total cost. So that means that you're going to have to divide the total cost by the number to get the cost per unit. Same thing with the exercise bikes. With the treadmills, after 1 month, a customer broke a treadmill and we had to sell it to a scrap dealer for 800. So again, what we have here is a disposal event. Remember, it's not always going to be as obvious as just a sale. Sometimes it'll be a breaking, sometimes it'll burn in a fire, sometimes it might get stolen, whatever it might be. Always look out for disposal events that are not as obvious. You've got your proceeds, you're going to be able to work out your recoupments and things like that. At the same time, one of our new exercise bikes, one of our customers asked if they could buy it, so we sold it to him for 7,000 Rand. Again, just remember, this is just one bike. We haven't entered into the business of buying and selling bikes. So when we get rid of this, it's going to be a capital disposal. It's not going to become revenue just because we're selling one bike. Some of the office equipment that we have survived the fire and was moved. So when you're seeing movement, you got to start to think about moving costs. So what have we got? We've got the cost of the original table, and we've got the cost to move it to its new location. Always remember, moving costs are going to be over the remaining life of the asset. Okay. The other thing to always look out for this: how much is the value of the asset, especially when they're small. Look out for things that are below 7,000 as a bit of a hint for the future. Be on the lookout for things that cost about 8,000, because after that they actually end up being below 7,000. Also tell you that before the fire happened, we spent 68,000 fixing a hole in the gym's swimming pool filtration system. They fixed the hole using a metal covering, which was a better material than the original plastic one, but plastic is now actually more expensive and it's cheaper to buy metal even though it's better. So I think you should be picking up that straight away we're going to have some kind of a discussion here about repairs, and the issues that you're going to have to be looking for are, well, is it an improvement Why did you affect the improvement? Are you replacing the subsidiary part of a whole, or are you replacing the entire asset? And then afterwards, I tell you, we also received a quote for $59,000 to do the same job from somebody else, but we decided to go with the more expensive person and actually pay the $68,000. So the question here you have to think about, do you have to take the cheapest quote? In tax, we're always looking for this idea of what is actually incurred, not necessarily incurred. So SARS can't come to you and say you have to have the cheapest one. They just have to say, does it meet the requirements of Section 11A or D or whatever it might be. Okay. So that's the start. That's when we speak about assets. The key things here are going to be allowances. It's going to be recoupments or Section 11Os when you sell, and it's going to be CGT. You're going to have to be looking at the number of years that you've had an asset for. Remember, I want to see you counting on your fingers. And yeah, that's pretty much the whole thing for the first part. Then we jump into the sales. Now, even though we had to close for a few months in the year, this is looking very reminiscent of where we are now. I had to stop my gym membership yesterday. They were closed for these months due to the move. Sales are still being quite strong. Customers sign a 12-month contract and pay monthly. The table below is used to calculate revenue for IFRS. So what we've got, cash received, less payments for prior periods, less prepayments for the next, gives you revenue as per IFRS. Now what you need to remember to think about is the difference between IFRS and accounting, which is going to be on the accrual basis, versus tax, which is on earlier of receipt or accrual. So stuff that has been received relating to prior years would have been included in a prior year. So I think it's safe to take that off. But just because if you've been paid something this year, but it relates to the next year, that's been received. So that's going to be part of gross income for tax, but not part of accounting profit. Okay. We then move further down and see that we also operate a sports shop from where we sell healthy snacks and clothing. We're given the sales figure, so nothing fancy there. They were not included in revenue above, very importantly. We have opening stock and closing stock. We have purchases. And then we see we donated 10 t-shirts to a PBO. They have a market value, okay, and a cost. So you need to decide, hey, is this a 22/8 recruitment? And at which value is it going to be? You also need to see that we were given stock by a competitor who was shutting down. Okay, they have a cost of $2,000. This is one of those situations we said will probably never happen in real life. But yeah, what do we do with stock for which we received and we didn't pay for it? As well as some stock that was damaged. We have the original cost. We now have the cost per unit. The difficult thing here is that I give you one of the values in total, but I give you the other value per shoes. So you need to do a bit of adjustment to see what the fix is going to be. I then give you expenses on employment costs. You've seen this come up once or twice. The employee's actual remuneration, less employee's tax, and the amount that was paid. You need to ask yourself, what was the amount actually incurred by Fitbits? Do you incur the gross amount or the net amount? I then also tell you the following is not included in the above. A motor car was purchased by Fitbits for use by the gym manager. I give you the date of purchase and the cost, as well as what the determined value is. The car was purchased with a maintenance plan. So you reading this in straight away, I'm hoping you're remembering stuff from last year about right of use of motor vehicles. And that's clearly going to be a fringe benefit for the employee. But you've probably never stopped to think about what is going to happen for Fitbits. They're the people that actually bought the car. Now, if you're listening to this before you've done the task, take a bit of time to think about what would happen there. Fitbits has paid the $250 and they've given it to the employee, and you're going to work out some kind of fringe benefit. So think about what the effects would be for Fitbits as well as Mrs. Semenya. Mrs. Semenya is awarded a bravery award, okay, for helping somebody. She gets $7,500 in cash from Fitbits. Now, the key things you need to remember here, bravery awards, there's that $5,000 reduction. But here's the key thing. I'm going to highlight that for you. Think about that and think if that has any effect on what is going on. Okay. There was a loan given to one of the trainers, Mr. Sam. Okay, it was given at a rate of 2% per annum, and Mr. Sam paid the money back on the 31st of August. So Fitbits is granted an employee a loan. They charge interest at 2% per year, and the employer paid it back during the year. So you need to think about what are the effects going to be for Fitbits, as well as possibly for the employee. The employee was given a long service award, as it was his 10th year with the company. Fitbits gave him a watch with a cost of $4,999 and the date that they gave it to him. Key things here: is this in cash or not? And how many years is required for something to qualify as a long service award? At the same time, there was a once-off payment of $100,000 given to Mr. Sam as a termination benefit. He was 67 years old and wasn't able to keep up with his work anymore. As such, he was paid his last salary in August along with the $100,000 in cash. Okay. Fitbits did not tell other staff members about this payment, as they did not usually give payments to employees who leave or retire. Awesome. Then some extra stuff about Mrs. Semenya. Here's her taxable income before any of the above. Here are the kilometers, private fuel costs, private insurance costs. Why are those going to be key? Well, you need those when working out the value of the fringe benefit. And I also told you that she sold her home in the year. We've got purchase price, we've got additions, and 25% of it is used as a home studio. So you know that there's going to be CGT, but there's going to be some kind of apportionment of the 2 million Rand exclusion that you have on CGT. Okay. I also tell you she got 4.5 million from the sale, and this amount was after commission. So Mrs. Semenya is paid a portion of the selling price as commission. You need to determine what the actual proceeds are and what effect this might have on the base cost. I also say she sold her gold coin collection, some key things, sold to her sister, so it's connected, as well as gold coins, so you know it can't be personal use. I give you the effects for Mr. Sam. Remember, he's old. I tell you stuff about his retirement, stuff we may not have done in a huge amount of depth, and about the payments for each of it. And then I also tell you that he contributed to an RAF, something that you have certainly done before. So you need to know what to do with that. Do you remember the limits for what's allowed to be deducted? You've got your rates under Section 11E. You've got the official rate of interest, and that's key for the fringe benefit. Now, straight away when you're seeing this, you're starting to think about, hey, is there a fringe benefit that is accruing for a low interest loan somewhere? If your employer gives you a loan at a very low rate, that's definitely a fringe benefit. Then you look at the requireds and you see, hey, there's a discussion about the repairs to the pool, which was expected. It's a smallish one, only 5 marks. There's a calculation of normal tax for Fitbits. I think that was quite expected as well. And then I also ask you for the taxable income for Mrs. Semenya and for Mr. Sam. So what's looking different here is that I'm actually asking you to do the tax of both sides of the transaction. Let me show you my face. I'm asking you to do both sides, and it's something I love to do because I want to know, can you do the deduction on one side and the inclusion on the other, or the other way around? Do you know how things work from both sides? And maybe that's a bit of a warning, but I think that you do need to know every side of a transaction and know it well. And what this speaks to is actually understanding rather than memory. If you're just trying to remember, ooh, I deduct this, I add this, I do that, it's not going to work out so well for you. You need to actually understand how a transaction flows to be able to answer these questions. If you haven't done the TUT yet, now's the time to go do it. If you have done it, I hope this made gave a bit of clarity about what's going on. And in the next video, I'm going to have the answers to the tutorial. So make sure you've done it, and then stay tuned for the next video.